Advanced level business, questions and answers, decision making to improve financial performance. What does the term investment mean? This is the act of risking money in order to gain a return, which could be in the form of profit, interest, or an appreciation in value. What does the term return on investment mean? This compares the initial amount invested to the amount of return. It is normally expressed as a percentage. What is meant by capital structure? This refers to the source of funds. Where did the business get its money from? For startups, it's either the owner's money or it's borrowed. Established businesses have the further option of using past profits. This is referred to as retained profit or reserves. Why is it advisable for a business to have a maximum of 50% of its capital in the form of loans? Well, borrowed money carries with it the obligation to pay interest, irrespective of whether the business has made any profit. Failure to pay interest could mean that the lenders, or normally banks, may force the business into liquidation, which means the business would cease to exist and its assets used to pay off any debts. What is the difference between cash flow and profit? Well, profit is what's left after all costs have been taken away from revenue. Essentially, it's money in minus money out. Whereas cash flow is about measuring and managing the inflows and outflows of cash with the objective of always being able to pay debts when they fall due. Why is it important to maintain capital spending? Well, capital spending refers to expenditure on things like factories and machinery. To make the business grow, you might need extra factories and machinery. Even to maintain its current size, the business will need to replace machinery that is worn out. What is gross profit? Gross profit is sales revenue minus cost of sales. Cost of sales is calculated by opening stock plus purchases minus closing stock. What does the term cost minimisation mean? Cost minimisation means reducing expenditure as much as possible, normally by reducing waste and using less labour. What is operating profit? Operating profit is that profit which is earned on the main activities of the business. It does not include interest payable or any income derived from other activities. What is profit for the year? This is how much the company has made after all deductions. This profit is then taxed by the government. The remainder is then divided between the shareholders in the form of dividend or reinvested in the company. This is called retained profit. What is sales revenue? This is the total amount of money that the company receives from selling its goods and services. What are fixed costs? Fixed costs are costs that do not change as output varies. Examples being rent and management salaries. What are variable costs? Variable costs do change with output. For example, raw material costs. As you make more products, you have to buy more raw materials. To identify whether a cost is either fixed or variable, just ask yourself, if we produce one more unit, will our costs increase? If the answer is yes, then the cost is likely to be variable. If no, then it's likely to be a fixed cost. What does the term contribution mean? It is the difference between the selling price and the variable cost per unit. What is the difference between profit maximising and profit satisficing? Profit maximisation is about squeezing every last drop of profit from the business. So that could mean cutting costs to the bone and exploiting your customers. Profit satisficing, however, is about earning enough profit to keep the main stakeholders satisfied. What does this table show? This is a 4-month cash flow forecast showing all money coming into the business and all money going out. The difference between the two is net cash flow. The opening balance is what's in the bank at the start of the month. The closing balance is what's in the bank at the end of the month. This is critical as, according to this forecast, the business will be overdrawn at the bank from January through to April. The business must take action, maybe by arranging an overdraft, or it will run out of money. How can a company's cash flow be improved? Well, it can chase receivable, that's customers that owe it money. It can delay payables, that's payment to suppliers. It could use a factoring company. It could arrange an overdraft facility with the bank. It could inject more capital into the business, either through a loan, by the owners putting more money into the business, or by inviting an investor to buy into the business. It could also try to reduce costs. State 4 internal influences on financial objectives. The ownership of the organisation. Is it a sole trader, partnership, private limited company, or a public limited company? The level of risk aversion by senior managers. This simply means how do the management view risk? Liquidity position. Is the company solvent? That means has it got enough money to pay its bills? The asset structure, whether the company is low geared or highly geared. State 6 external influences on financial objectives. Changes in these external variables can affect either revenue or costs, or sometimes both, thereby affecting profitability. So we have our pastel again, so political. So, for example, a ban on Russian imports, economic, interest rate rises, social, an ageing population shifting demand towards other products, technological change, introduction of new technology making existing technology obsolete, the environment with CO2 emissions, and legal example would be minimum wage legislation. How can firms prepare for external changes? By being flexible and being aware of changes and potential changes in its environment and preparing contingency plans. Contingency plan is like a plan B. What are budgets? These are financial plans and targets which derive from the overall corporate objectives. There will be labour budgets, production budgets, sales budgets and capital budgets. They are targets which managers try to achieve. What is meant by an adverse variance? An adverse variance is where the actual performance is worse than predicted, such that it would reduce the level of profit. What is meant by a favourable variance? A favourable variance is where the actual performance is better than the target, such that profitability is actually improved. Okay, we're now going to look at some numerical examples. So a business has sales of 20,000 units at £10 each. It has variable costs of £5 per unit and has fixed costs of 80,000. Calculate its profit, its break-even point, and its margin of safety. So first of all, working out its total revenue, that's money coming in to the business. It sells 20,000 units at £10 a time, so that will give a total revenue of £200,000. From that, we must subtract the costs. Now, the total variable cost is £5 times 20,000. To that, we add the fixed costs, which is 80,000. So that gives total cost of 180,000. So when we subtract that away from the 200,000, we end up with £20,000 profit. Now, the break-even point is the point at which neither a loss or a profit is made. It's where total revenue is exactly equal to total cost. And this is arrived at by using the formula of fixed cost divided by unit contribution. So here we have fixed cost of 80,000. Our unit contribution is £10 minus £5, which is 5, and that computes to 16,000 units. Lastly, the margin of safety is the difference between what the company is actually producing and its break-even point. So we said that it's producing 20,000 units. The break-even point is 16,000 units. So it has a margin of safety of 4,000 units. This simply means that it can afford for production to fall by 4,000 units before it is no longer making a profit. This is a break-even chart for Premier Footballs Limited. Question 1, what is the break-even point? 2, what is the price? 3, what is the fixed cost? 4, what is the variable cost? 5, what will be the profit at an output of 80 units? 6, what will be the loss at an output of 10 units? And 7, what is the margin of safety at 80 units? Let's have a look at these individually. So what is the break-even point? Well, the break-even point is where the blue revenue line cuts the red total cost line. And this is at an output of 45 units. Anything to the left of that will be a loss. Anything to the right of that is a profit. What is the price? Well, at an output of 100 units, total revenue is £2,000. Therefore, 2,000 divided by 100 equals 20. So the price of each football must have been £20. What is the fixed cost? Well, as the fixed cost does not change with output, it is a flat line horizontal to the output axis at £400. What is the variable cost? Well, the total variable cost at 100 units is the difference between the fixed costs and the total costs. So 1,500 minus 400 is £1,100. Now, dividing by the output gives a unit variable cost of 1,100 divided by 100 equals £11. Okay, so the variable cost for each football is £11. What will be the profit at an output of 80 units? Well, this is the vertical distance between the total cost, the red line, and the total revenue, the blue line. You read off from the cost and revenue axis, so that will give a profit of £250. Question 6, what will be the loss at an output of 10 units? Again, this is the vertical distance between the total cost, the red line, and the total revenue, blue line. Read off from the cost and revenue axis. So this time it is a loss of £250. Number 7, what is the margin of safety at 80 units? Well, the margin of safety is the difference between current output and the break-even point. At 80 units, this will be 35 units. This means output could fall by 35 units before a loss is incurred. State 3 forms of internal finance. The owner's or shareholder's injection of money, selling an asset for cash, or managing cash flow more effectively. State and explain 6 forms of external finance. Loans, this is borrowing a fixed sum over a fixed number of years. The loan may be secured where the bank requires collateral, which is an asset that may be seized in the event of non-payment, or unsecured, no collateral required. Interest rates may be fixed or variable. An overdraft, this is an agreement which allows a bank's customer to take out more money than is in his or her account up to an agreed limit. Interest is charged on the amount outstanding. The amount owed is reduced as the money is paid back into the account. Overdrafts are an extremely common form of financing for business. Factoring, where the business uses a factoring company, normally a bank, to advance on receivables from customers. This substantially improves cash flow. The sequence for this is as follows. So a customer orders goods from a supplier. The goods are delivered and the customer takes ownership with 30 days to pay. The supplier then sells the invoice to a factoring company and receives up to 90% of the value of the invoice immediately. The factoring company, say after 30 days, obtains full payment from the customer and passes the last 10% onto the supplier, less factoring fees. Leasing. Here firms enter into a contract which is the equivalent of a long-term rental on property, vehicles or machinery. This does not tie up the firm's capital. Sale and leaseback. Here firms may sell their head office, building or factory to a bank or insurance company and then rent it back, thereby releasing large amounts of capital. Trade credit. This is where suppliers allow a period of time before payment for goods delivered or services provided is required. It's normally 30, 60 or 90 days. Venture capital, inviting outside investors to buy into the business. Although this will increase liquidity, it also dilutes equity because in effect you're selling off part of the business. Just think of Dragon's Den for this example. How may a company improve profitability? Well, profit equals sales revenue minus total costs. Hence, profitability can be increased by increasing sales revenue, selling more or raising the price, depending upon the price elasticity of demand. Alternatively, firms can reduce total costs by having lower variable costs for materials or using less labour or reducing fixed costs. That's overheads. Okay, well, that brings us to the end of 3.5. All that remains is our customary multiple choice. So here we have 20 questions. If you've got this sheet in front of you, then great. If not, just jot down 1 to 20 and write down the appropriate answer as we go through them. Question 1. A company sells 30,000 units at £20 each. It buys them in at £8 each. It has expenses of £60,000. It has interest payments of £10,000. Its sales revenue is A, 240,000, B, 70,000, C, 600,000, or D, 60,000. Question 2. A company sells 30,000 units at £20 each. It buys them in at £8 each. It has expenses of 60,000. It has interest payments of 10,000. Its gross profit is A, 50,000, B, 300,000, C, 400,000, or D, 360,000. Question 3. A company sells 30,000 units at £20 each. It buys them in at £8 each. It has expenses of 60,000. It has interest payments of 10,000. Its operating profit is A, 360,000, B, 300,000, C, 250,000, or D, 290,000? Question 4. A company sells 30,000 units at £20 each. It buys them in at £8 each. It has expenses of 60,000. It has interest payments of 10,000. Its profit for the year is A, 360,000, B, 290,000, C, 60,000, or D, 540,000. Which of the following was an adverse variance? A, actual expenditure on ingredients for cookies was higher than budgeted. B, sales of cookies was more than budgeted. Labour costs were less than budgeted. Or D, actual expenditure on ingredients for cookies was lower than budgeted. Question 6. What is the formula for total contribution? A, contribution per unit divided by total costs. B, quantity sold times selling price. C, contribution per unit times quantity sold. Or D, selling price times total cost. Gross profit can be defined as operating profit plus other profits. B, cost of sales minus operating expenses. C, sales revenue minus operating profit. Or D, sales revenue minus cost of sales. Question 8. A company is financed with £100,000 of owner's capital and a long-term loan of £40,000. The company is A, low geared, B, highly geared, C, under geared, or D, over geared. Question 9. Which of the following is not an external source of finance? A, loans, B, overdraft, C, trade credit, or D, owner's capital. Question 10. Contribution means fixed cost plus variable costs. B, selling price minus variable costs. C, selling price minus fixed costs. Or D, fixed cost divided by selling price. Question 11. The break-even formula is A, selling price minus variable cost divided by fixed costs. B, variable cost minus selling price divided by fixed costs. C, fixed cost divided by selling price minus variable cost. Or D, fixed cost times selling price divided by variable cost. Question 12. A cash flow forecast. A, shows profits for a period of time. B, shows inflows and outflows of cash for the previous year. C, shows inflows and outflows of cash for a future time period. Or D, shows losses for the next 3 months. Question 13. In the context of cash flow forecasting, which of the following statements is true? A, credit sales are financed with a credit card. B, cash sales are an immediate cash inflow, whereas credit sales are not. C, cash sales mean goods are purchased with pound notes. D, credit sales are mostly between businesses and consumers. Question 14. A budget is A, forecast of revenues and expenditure. B, a plan of future revenues and expenditures. C, a business plan aimed at families on a budget. Or D, a comparison of fixed costs to variable costs. Question 15. Why is the sales budget the most important budget? A, because revenue is more important than cost control. B, sales directors have more power. C, because it is likely to be the most accurate. Or D, because all other budgets are dependent upon it. Question 16. At the end of the month, a firm's cash flow forecast is negative. Which actions would not help solve the problem? A, an injection of more capital by the owners. B, arranging an overdraft with a bank. C, delaying payments to trade suppliers, or D, speeding up payments to trade suppliers? Question 17. Profit maximisation means A, making as much profit as possible, B, maximising sales, C, minimising costs, or D, costs are greater than revenue. Question 18. Which of these is not an internal form of finance? A, owner's capital, B, retained profits, C, selling a company asset, or D, trade credit? Question 19. Which of the following would not offer a solution to a cash flow problem? A, factoring an invoice, B, arranging an overdraft, C, selling an asset, or D, taking on a big order? Question 20. A favourable variance could be caused by any of the following except A, decrease in sales revenue, B, an increase in price, C, a reduction in overheads, or D, a reduction in variable cost. So all that remains is to check your answers. So here we go. 1 is C, 2 is D, 3 is B, 4 is B, 5 is A, 6 is C, 7 is D, 8 is A, 9 is D, 10 is B, 11 is C, 12 is C, 13 is B, 14 is B, 15 is D, 16 is D, 17 is A, 18 is D, 19 is D, and 20 is A. Okay, so that brings us to the end of the finance module. So I'll see you next time when we are going to look at human resources. See you then.